Hi everyone, and welcome to our Tuesday Q&A. Hope you've all been well, and the people in Asia are looking forward to Chinese New Year coming up later this week. This week's question is, it's an interesting one. It's been sent to us by one of our viewers in London, and I thought I'd cover it off because Phil Lowe, in charge of Australia's RBA, has come out just last week and made some comments about monetary policy and quantitative easing and the things that the RBA are doing, which I think they're doing actually rather well, to make the Australian economy try and recover as quickly as possible and continue to drive employment up. So our viewer said, look, what's the role of QE in inflating asset bubbles, like property and shares, and to what extent? And what happens when QE ends? So they're all good questions, and a lot of people have been asking me similar things, so let's just go through that a little bit. I'll go over it with an Australian context in mind, obviously, because we're broadcasting to a viewing audience that is basically Australian and Australian expats abroad. So I look at this from an Australian-centric viewpoint, and it's really quite interesting how things interplay, because in Australia, for example, I don't believe that QE that the RBA has announced is in any way impacting property prices as such, and I'll go through why I believe that. And in terms of the global experience, what that's actually giving us, and why it's very difficult for the central bank to actually act in conjunction with things that are happening overseas that people may not actually recognise. So let's go from the top down and work it out. The RBA is trying to drive employment up and unemployment down. It's trying to put a bit of a handbrake on the Australian dollar. It's doing a lot of things, which I said I think the RBA board is doing a terrific job, and we should be actually, applauding them in terms of what they're doing. A lot of people believe that this concept of easy money and money printing, and when are we going to repay this, all of these terms that I hear all the time, but really a lot of that is just clickbait and journalists trying to promote a bit of news, as it were, which isn't news. We've got to look at the reality, and the reality is that the RBA said, look, we want inflation to be back between our target band of 2 to 3% per annum, and bear in mind, for the last half a decade plus, it's never been between 2 or 3% their target band. So clearly they're going to do some extra work to get it there, and they're not that concerned about overshooting the mark for some time. Not forever, but for some time, to get it normalised, I guess, within that band. So we've got to look at that. We've got to look at what's happening. So the unemployment numbers have been contracting, which is great, and perhaps faster than some economists had expected. So that's also showing that what the RBA is doing is proactive and it's working. And thirdly, the Aussie dollar has been constrained largely because of the RBA's QE monetary policies, because otherwise I'm sure it would actually be probably trading at 82 or 83 cents to the US dollar now. So we've got to look at all of that, because that's protecting Australian industry, Australian business, and we've got to put all of that in context. People have got to bear this in mind. So simply to think that QE is going to drive asset bubbles, I think is a fallacy, especially in a country like Australia, where we have very robust constraints in terms of bank lending. I haven't seen bank lending credit policies as tough as these for a long time, decades. So, and all you've got to do is ask any of our clients or anyone that you know who's going for a loan at the moment and say, is it really easy to get money? And the answer would be no, it's incredibly hard. So until something like that happens and you have irresponsible lending, the money momentum is simply not there, and that's what creates asset bubbles. It's easy access to easy money and the flow of that money which creates bubbles. And I think Australia has proven in the past that that's not likely to happen. We don't have a ninja loan situation that was apparent in the US and caused the subprime credit crisis. So banks will continue to lend responsibly, even if the legislation goes through which limits the responsible lending obligations, and that's really obligations on the bank to verify information that customers are giving them, not to make it irresponsible, and people often forget that. It just removes a layer of administrative constraint, which I believe is largely not that useful at the moment, because unless you're giving fraudulent information to the bank, it doesn't make any difference. So that's worth bearing in mind. So, and even if, for whatever reason, that were to come to pass, that irresponsible lending as such came to the fore, look, the macro-prudential measures that APRA can wield is fairly intense, as we saw in 2017. The house price deflation, if you like, that came to pass was actually created. It was created by macro-prudential measures, and the regulators made house prices contract on average over 10% around the country. So I don't think there's any real danger of an asset bubble forming in Australian property. Unlike many commentators and things that you might read in newspapers and newswires, I'm very comfortable with that. And Philip Lowe, the head of the RBA, feels the same, as does Guy DeBell, his deputy, and I think both of them doing a sterling job at the moment. So let's look at that. Let's look at the impacts that QE might have. And I'll tell you why I don't think it's going to create an asset bubble, because most people in Australia, unlike other countries, particularly the US, will take out variable interest mortgages, so rather than long fixed term mortgages. If you do take a fixed rate mortgage in Australia, it's typically 1, 2, 3 years at the moment, perhaps up to 5 years, but anyway, as an aside, so the banks will swap longer term rates back to the overnight cash rate plus a margin anyway. So it's not going to have an impact, because QE is basically the Reserve Bank buying 5 to 10 year government bonds and keeping the lid, I suppose, on long-term interest rates, which will put a dampening effect on the Australian dollar and thereby protect our economy and businesses in Australia, whether they're importers or exporters. So everyone really gets to benefit from that, and I applaud the RBA for doing this. So really important to look at that. All it's doing is keeping interest rates down, which is great, because as borrowers, we can all benefit from that. So it's much cheaper to go and borrow money. It doesn't mean you can suddenly rush out and the bank will give you $10 million to go and spend on anything that you choose. It's actually nothing like that at all. So, it's really important to bear this in mind. So next time when you look at a story about asset bubbles or, people, and they're generally perhaps older people that say, what are our grandkids going to do? How's this money going to be repaid? Well, the reality is it may or may not be in some respect. So let's look at this. Let's look at the RBA is also doing a great job for the government, because keeping the cost of borrowing down keeps the cost of borrowing down also for the government, as well as us in terms of the retail environment. So they can continue on this path, I think, for some time. I think when the current rate of 5 to 10 year bond buying, or QE2 as we can call it, runs out, there'll be QE3, and then there possibly may be more. And this may even form a longer term, part of the economic and regulatory toolkit that the RBA utilises to make sure that Aussies are basically no worse off than people in other parts of the world, because you've got to look at it, and Australia really still has the highest interest rates of most developed nations. So people should remember that. We're not in negative territory, and we still have these high interest rates, which makes the Australian dollar attractive and will put upward pressure on it when you've got reserve banks and central banks in other parts of the globe continually escalating their QE measures and reducing rates and having negative rates. So it's basically making sure that we sort of stay in line or keep parity with what's happening globally, and people misunderstand and forget a lot of this, because a lot of the terminology that's used is perhaps not that insightful in terms of what it actually does, what it does for people working, the employers and the employees working in Australia are all benefiting by this. So keeping the cost of borrowing down and telling people effectively that's going to stay like this for at least another 3 years. So last week, Philip Lowe came out and said, look, we're going to keep the cash rate at its lower bound of 0.1% for at least another 3 years and keep the 3-year bond rate down at the same 0.1% level. That's basically saying to people, look, don't be frightened that we're going to taper out bond buying. Don't be frightened that we're not going to do whatever it takes to make sure that we do get back to full employment as quickly as we can, but being realistic, and I think they are, that's going to take quite some time. It might take till 2023, 24 to get there. So we've got to make sure that people understand this is not a flash in the pan, that they feel confidence in going out and perhaps borrowing money to expand on business expenditure, on creating more jobs, as it were, through that as investments, and for people, for the general public, to feel confident that they can go out and borrow money without the prospect of rates shooting away from them. So all of those things are occurring, and what happens, I guess the second part of, or third part of that question, what happens when QE ends? Well, that's a really good question. Seeing as I don't think it will have created any large extent asset bubbles in Australian property anyway, I think things will continue in a very measured and meaningfully positive way. So I don't see any downside in that. And as I said, we may actually get targeted sort of clinical surgical uses of QE ongoing. And I think that may be necessary in the shorter term, certainly, as certain industries are going to struggle. Let's face it, international travel, I think everyone knows, is really going to be severely impaired for perhaps the next 2 to 3 years. And therefore, there are going to be certain parts of the economy, certain sectors in industry that are going to need specific help, I suppose. And what we've seen so far is that the government, the Reserve Bank, the regulators, everyone's come to the party to do a really good job. And Australia has fared so much better than just about any nation globally in terms of how it's handled the situation with the coronavirus pandemic. Whilst I think some of the fragmented responses from various state governments are certainly not a positive, I think if we can get a national overlay to coordinate responses on a measured basis, that would be an even greater positive to the scenario. But overall, one would have to say, look, Australia's done a really sterling job in this, and we should really thank them for following through on perhaps some hard policy decisions. So that's what I believe is going to happen in the medium and longer term. I don't think there's any cause for concern, but on the flip side of that, I think that potentially property prices will continue to move up, and I think they could move up relatively meaningfully over the next 3 to 4 years. So that's something to bear in mind. So where people are wanting to be conservative, then at the moment sitting on a whole pile of cash with no growth assets is probably the most non-conservative approach that anyone could take, because we have been told cash is not going anywhere, so it's being devalued, and growth assets are really probably the place where you're going to get an expansion in your asset base. So I think if you're going to be conservative, that's what people need to look at. Be measured in what you're trying to achieve. Don't try and shoot the lights out, as some people that I know tend to do. So be conservative in having a process, in having a vision, and in trying to make sure that you utilise this next period of history, which I think is incredible, to give yourself the best opportunity to move forward. And I mean move forward in a financial and commercial manner that's staying within your means and not creating any angst, but utilising what the world is throwing at us. I can cover off international, I suppose, areas for anyone who has a particular bent on that, but being Aussie-centric, I thought I'd focus our discussion today on what I think these QE measures hold in store for the Aussie economy and for Aussie growth assets. In particular, I'm speaking about property at the moment, but in similar bases, equities being another growth asset. Again, if we utilise the same parameters, generally speaking, we'd say to clients, look, limit your your exposure to debt or mark-to-market assets to make sure that there's no potential for equity deletion risk in case of market movements. As always, I hope you enjoyed this, and to all our viewers out there, please keep sending in your questions and we'll try to get to as many of them as we can. Otherwise, feel free to reach out and we can try to book a personal meeting via Zoom, and follow us on either LinkedIn, Facebook or Instagram to make sure that you're kept up to breast with all the latest information as we see coming through to you. All the best.